Welcome, ladies and gentlemen, to Lesson 8, Standard Cost System. In this lesson, we're going to understand the fundamentals of a standard cost system. We're going to learn the different type of analyses, variance analyses that management use in a standard cost system. We're going to go through flexible budgets and static budgets and learn the difference between the two. And then we're going to go through various examples of variance analyses that management use. Alright, so let's get started. Have the Lesson 8 cheat sheet in front of you. Turn to the concepts and definitions side. We're going to start right here, middle to left. We're going to say define what a standard is. A standard is a benchmark or a norm for measuring performance. So it's a benchmark or a norm for measuring performance. It's something that we're going to measure performance against. That's the standard. Standard cost system, the foundation of a managerial cost control system. So it's a cost control. Remember, control is monitoring how we're doing against the plan. So when we're controlling an organization, we're not necessarily controlling every movement. We're monitoring how it's performing against our plan. In this case, budget. Right? Most of management's plans take form of a budget. So it's the foundation of a managerial cost control system. Differing from a job order costing or a process cost system, in that it records cost at a standard. And remember, a standard is a benchmark or a norm. That's an estimate. It's a standard rather than the actual cost. So we got an estimate versus the actual. So job order costing, process costing, those are at actual. Standards are at an estimate cost. All right. Standards are estimates set in advance and reflect what units should cost. Let's go up to the different types of standards. We've got quantity standards. Quantity standards specify how much an input should be used to make a product or provide a service. And then cost or price standards, we're going to refer to those cost, price. That's going to be interchangeable when we're referring to the other type of standard. There's the quantity standard, then there's the cost/price standard. That specifies how much we should pay for each unit of input. So then if the standard cost system is the base of control, we're going to have variances against those standards, right? So let's talk about the different types of variance. So a variance is the difference between actual costs and budgeted or standard costs, right? A favorable variance happens when actual costs are less than budgeted or standard costs, and an unfavorable variance happens when actual costs are more than budgeted or standard costs. In a standard cost system, unfavorable variances are equivalent to underapplied overhead, and favorable variances are equivalent to overapplied overhead. The sum of the overhead variances equal the under or overapplied overhead cost for a period. So going back to lessons 2, lesson 3, when we were looking at the overapplied, underapplied, well, in a standard cost system, we refer to those over, underapplied as favorable or unfavorable variances. Same concept in that we've got an estimate in lesson 2, lesson 3. That estimate was manufacturing overhead, and we were applying it at an estimate. But now in a standard cost system, we're going to have quantity standards, so quantity estimates, and we're going to have price standards or cost standards, and those are going to be estimates also. So we're going to have a lot of variances when we're looking at standard cost system. Let's talk about some of those variances down here. We've got material price variance. That's the difference between the actual price and the standard price for materials. We've got a materials quantity variance. I'm going to go through these pretty quickly because we got examples, and also you're going to have these on your cheat sheet. You're also going to have these in your flashcards. So I'm going to go through these variances pretty quickly because there's a lot to it, but we're going to go through examples, and that'll probably help you out more. Materials quantity variance, the difference between the actual materials quantity used and the standard multiplied by the standard price. Material spending variance combines the material price variance and the quantity variance. Labor rate variance, the difference between the actual labor rate and the standard rate multiplied by the actual labor hours. Labor efficiency variance is the difference between the actual labor hours used and the standard labor hours used multiplied by the standard labor rate. The production manager is responsible for these variances. And then labor spending variance combines the labor rate and labor efficiency variances. Starting to see a pattern here, right? Okay, variable overhead rate variance, that's the difference between the actual variable overhead rate and the standard rate multiplied by the actual value of the cost driver. Then the variable overhead efficiency variance, that's the difference between the actual cost driver units used and the standard cost driver units multiplied by the standard variable overhead rate. Now that's a mouthful. If you look over here to the left, all that stuff is graphically, or better demonstrated in a chart and in sort of formulas, but let's talk about some other concepts and definitions up here first, and then we're going to go over to the left-hand side and look at these charts. We've got cost flow of standard cost accounting. So inventories are recorded at standard cost. Remember, in a job order costing system or a process costing system, we were recording inventories at actual Whereas here we're recording inventories at a standard, so that's an estimate. Variants are recorded as follows. Favorable variances are credits, represent savings in production costs. Unfavorable variances are debits, representing excess. Remember, so favorable is equal to what was it, underapplied, unfavorable is underapplied and favorable is overapplied, and that's the same. So when we were talking about in lessons 2, lessons 3, when we had underapplied, that was a debit, and we had overapplied, that was a credit. Going back up to the standard cost flow, we got standard cost variances are usually closed to cost of goods sold. That was similar to what we did in lessons 2, lesson 3. Favorable variances decrease cost of goods sold. Unfavorable variances increase cost of goods sold. That's the same as we did in lesson 2, but now we're just calling it something different because we're in a standard cost system, not in the job order costing system or the process costing system. Static budget, a budget that is used based on a single fixed estimate of sales volume. Flexible budget, a budget that shows how costs and revenues will change across different sales volumes. Actual quantity, the amount of direct materials, direct labor, and variable manufacturing overhead actually used. Standard quantity, that's the standard quantity allowed for the actual output for the period. Actual price, the amount actually paid for the input used. Standard price, the amount that should have been paid for the input used based on the standard. Alright, now in setting up, we're going to move over here to the left-hand side of these charts. In setting up standards, who sets up standards? We're accountants, the engineers, the purchasing agents, and the production managers. They all come together, combine efforts to come up with standards, right? Because the accountants can't do it alone because we're not in the factory, we're not making products, so we don't know how long it takes or what it should cost, right? Those are the purchasing managers, those are the production managers. So all of us get together and come up with standards. Now, ideal standards can only be achieved under perfect conditions, right? So we don't want to set ideal standards, we want to set realistic standards. Alright, so how does the standard cost system flow? We've got this flow chart. So the first thing is we're going to, what we're going to do, we're going to prepare standard cost, first thing we're going to do is perform business activities, right? And from there, we're going to prepare standard cost performance report. From there, we're going to do a variance analysis. We're going to identify exceptions, receive explanations, take corrective actions, revise standards, that's going to get additional input. And then once we revise standards, we're going to go and we're going to perform next period's business activities. Then we're going to prepare cost performance reports, which take the form of variance analyses. And now, what's a variance analysis? Well, the variance analysis is what we talked about here. We're going to get favorable variances, unfavorable variances. So a variance analysis, there's under the price and the quantity, there's two types of variances. There's price variance and the quantity variance. So what happens is we come up with a variance, and we have to figure out why we had that variance, right? Because at the beginning of the period, the accountants, the engineers, the purchasing managers, the production managers, we all got together and said, what's our best estimate? What's it going to take? What's the realistic amount of materials, labor, overhead that it's going to take? And then at the end of the period, we're gonna look at those and say, what did it actually take versus our estimate? And we're going to need an explanation for that because somebody's going to be accountable for that. Maybe the production manager was too conservative or he was too aggressive. We're going to need to account for that so that next period we can set better standards, right? So we're gonna find reasons. Once we find the variance, we're gonna find the reasons about why there was a difference between actual price or standard price, or actual quantity versus standard quantity. Those reasons can take the form of a couple different types. They can take the type of a materials price variance, a labor rate variance, a variable overhead spending variance, and quantity and price variances both have those different types of variances. So we're going to look at examples of those on the other side of the lesson plan. So don't get too worried right now if you don't understand that, but we're going to go through examples. How we calculate price and quantity variance, it's a function of the actual quantity, the actual price, and the standard price and the standard quantity put into different formulas. So to calculate, and you'll see here the formula, to calculate price variance equals actual quantity times actual price minus actual quantity times standard price. That's the price variance. And then we calculate quantity variance by multiplying the actual quantity times the standard price. Subtract from that the standard quantity times the standard price. Alright. As a formula, it's good to understand because we're going to want to put that, we're going to get given information, we're going to need to solve a problem, and so we're going to want to know where to put that in the formula. That's how you calculate the price variance and the quantity variance. Now we're going to go into these things called variable overhead variances. And how do we calculate variable overhead variances? Well, you're going to do that you're going to come up with two different types of variances there: spending variance and efficiency variance. How do you calculate those? The spending variance is going to be actual overhead and times actual rate minus the standard rate. And then the efficiency variance variable is going to be the standard rate minus actual overhead work times the actual overhead minus the standard overhead. Now, it'll be easier when we go through an example, but that's the formula. That's good. That you're going to need to understand. Then up here, there's the fixed overhead variance model. Now, the fixed overhead variance model, similar, we're going to come up with a budget variance and a volume variance. How do we do that? Well, we're going to take the actual overhead minus the denominator hours times the standard fixed overhead rate. That's going to get our budget variance, and then our volume variance is going to be that denominator hours times our fixed overhead rate minus the standard hours times our fixed overhead rate. That we're also going to see an example, but it's good to know the formula, and it's good to know what each of the the variables mean in those equations. Before we get into the overhead and the variance analysis, let's look at the first thing, which is a standard cost card. So a standard cost card is a form that summarizes how much the company should spend to make a single unit of product based on expected production and sales for the forthcoming period. So a standard cost card, basically, it just documents what our standard costs are. So if you look down here under the red number 1 in very small print, it's very small because it's not too important, because it basically is a multiplication. But the standard cost card, so right here we have a standard cost card for a 14-foot aluminum boat, and we're saying the inputs for a 14-foot aluminum boat are direct materials, direct labor, and variable manufacturing overhead. So what we do is we come up with a standard quantity or standard hours. That's the amount that we expect or estimate that need to go into the production of a 14-foot aluminum boat. So we got 45 pounds of direct materials, we got 7.5 hours of direct labor, and 2.5 hours of variable overhead hours. What we then have is a standard price or rate for each of those inputs, and for materials it's 89 cents per pound, for labor it's $20 per hour, and for variable overhead it's $1.46 per hour. And those are our standards. So then the standard cost per unit is the sum of all of those different inputs, right? So it's $40.50 for the aluminum, it's $150 for the labor, and it's $3.65 for the overhead. So the standard cost per 14-foot aluminum boat is $193.70, and that's what a standard cost card looks like. It documents the direct materials, direct labor, variable, and then the variable manufacturing overhead that we're going to apply. We put the standard quantity, we put the standard price or the standard rate, and then we extend that, and then we sum it, and we get a standard cost per unit. That is what a standard cost card looks like. Now let's move over to the red 2, where we're going to go through what a static budget looks like, and then we're going to use that static budget and see its shortfalls. So first, 1. Okay, so 2. Roundbelly was unable to achieve their desired level of direct labor hours, resulting in a 4,000 hour unfavorable variance. However, from the